Mike Muller, head of Vitol in Asia. Mike, since we last had the chance to talk, we've had two major developments, you would think, in the energy markets. OPEC Plus made the commitment to further cuts, including the Saudi unilateral cut, which takes effect this month of 1 million barrels a day. And also we had that major geopolitical event in Russia over the month of June. And yet neither of these things seems to have shaken the barnacle off the rock of $75 Brent. How do you read this market given those major events, and yet the oil price remains ultimately static where it was before these big events happened?
Thank you, Sean. I would say the outcome of the OPEC Plus meeting, whereby Saudi Arabia took a unilateral move to take extra production off the market in the month of July, came at a time where the experts in the market were expecting a phase during the calendar year where there was going to be a tightening of the supply-demand balance anyway. And as such, there was going to be a tailwind for those that wish to see prices supported. For that extra volume to be taken off the market, therefore just added to the tailwind. But of course, the reason it was done was the general overtones of a softer economic global picture, fueled not least by concerns around Chinese demand, or rather disappointing lack thereof. And as such, I think there's your explanation for why the markets have generally held at more or less the levels that we were at before the OPEC Plus meeting, mid-70s. Yes, there was an excursion down to the low 70s, but on the whole, what we have here is a relative period of flat price stability on Brent crude oil and OPEC basket prices. There's a lot more that can be said about global movements of other goods. And if you look at certain leading indicators that the oil market tends to take a cue from, the petrochemical sector, for example, still doesn't look particularly healthy. The Chinese construction sector is not underpinning certain markets that are energy intensive. And if you look at shipping markets, those are not giving you particularly bullish vibes at the moment also. So as such, I think we have a sense of balance rather than the predicted tightening of a market, which may yet occur later this year. There is some speculation now, of course, what happens as OPEC move into their Vienna conference latter part of this coming week, 5th and 6th of July. But that's obviously a larger forum where multiple third parties are invited to attend and exchange opinion. So I expect that to be more of a seminar rather than an actual event, which could lead to further surprising news.
I wanted just to come back to this idea of where this market is, supply and demand. I mean, we've for much of the sort of recent months, we've kind of been in a demand weakness narrative. But it strikes me that we're now in a supply excess narrative rather than demand weakness. Demand is still at 100 million barrel a day plus oil market, but yet supply seems to be greater than predicted. And so I come back to the comment you made at the recent MPGC event in Dubai. And if I paraphrase you correctly, you said that the second half of the year would see 2 million barrels a day more demand than where we were currently at. And that was, I think, about a month or so ago. Is that still your perspective? How do you see that balance going into the second half, this year of two halves? Does that narrative still survive?
Yes, perhaps I need to clarify. There's a general consensus which has been echoed in conferences since MPGC also, that supply is a little bit higher than most had anticipated, whether you look at provinces like Guyana bringing on streams, whether they're looking at US output. And then on the demand side, it's just disappointed a little, as I alluded to before, not just with China, but the general softer global economic outlook for energy intensive industries. At the same time, of course, there's been a penetration of cheaper fuels into the space traditionally occupied by oil, namely coal, certainly in Asia, which is also the LNG story I've talked about many times over. So then to the seasonal aspect, I think most research shops and most research departments in Wall Street banks and large energy majors have a consensus around the fact that the year-on-year demand versus 2022 is up in the order of 2 million barrels a day, some are a little shy of that. And of course, there are a couple of definition issues around whether you put gas liquids and condensates into the mix or not, which of course are not in the OPEC plus total, for example. Within that range, and that consensus is pretty good since we're halfway through the year already, there is an expectation that there will be an acceleration in demand of jet fuel, which is still the major cut of the barrel where demand is missing. Largely, if you can oversimplify it down to the fact that we still don't have much international travel in and out of China and various other countries that haven't really come back to full travel since COVID, but primarily China. Overlay on top of that, the fact that there is a seasonal recovery in demand driven out of the West in summer and then Asia in Q3, Q4. You have this seasonal uptick in demand, which always characterizes the oil demand shape of the curve between Q2 and the second half of the year. So that's normally less than 2 million barrels a day, but it's compounded by the expectation that we will see more jet fuel demand. And even though we still don't see too many Chinese tourists around places like Southeast Asia, that expectation is there. If you look at the forward schedules of airlines, etc., and put all that into the mix, there is still a view that yes, there will be an acceleration in demand. Whether it's the order of magnitude I highlighted MPGC, probably not quite, but that is still very much the underlying scenario. Of course,
on that, I just wanted to jump in, Mike, on that and ask you your thoughts. If Saudi Arabia was not to continue with its 1 million barrel a day cut beyond July, would the market react bearishly to that? Would that be difficult for prices and holding in the range they are at the moment?
That's a relatively easy one to answer, really, Sean, because it's always down to gauging what the market's expecting. Where is the consensus ahead of any next decision point? So
that is the biggest next decision point, isn't it, on supply? OPEC, as we said, are meeting this week in Vienna, but that's a seminar, as you said. Saudi is in its own corridor now on this 1 million barrel a day cut, which is only for a month, and then they can decide, as they've said, what they will do. But in essence, they've kind of got themselves into a corridor here. To step away from it would be seen as quite bearish, I would have thought.
No, I think the market would agree that when the large producer says they're going to do something, they typically follow through. Of course, July was very prompt and upon us in trading terms. It had already elapsed and traded. So in that sense, people are now going to be looking for confirmation, and they may not necessarily see it in the shape of reduced exports from the kingdom. They may well see it in terms of stock draws and in terms of the very large downstream system that Saudi Aramco has control over. And if you have to put various components together to assemble that total cut. So yes, I've heard speculation that they may contemplate extending it into yet another month. I think there is a consensus in the market. Had they announced a multi-month cut up front, that might have had a even stronger impact on markets than the 1 month did. But the fact that the market still seems to be trading in a reasonable balance. If you look at Brent, for example, the front spread, the backwardation between first and second month on ICE is barely positive. It went to almost zero. That's not telling you that we have a particularly strong market at the very front end, despite these volumes being taken off the market. So I guess we need to see a little more time elapse for us to see what the effect of this million barrel a day cut is and how it cascades through from essentially Asian priced sour barrels into the actual benchmark crudes, namely Brent and Dubai. But I think it is fair to also point to the OSPs, not just the Saudi OSPs, but all the other GCC and core OPEC OSPs to see that there is an intent there to price their baseload oil from many refiners at a more premium level to trigger an abstinence from those grades, and to have those refiners that would have nominated Saudi and Iraqi and Kuwaiti and Qatari and Emirati oil to go after alternatives. And those swing alternatives tend to be the spot barrels from the Atlantic Basin. So it's a little early still to see how all that plays out, but it should end up seeing a realignment of trade flows and a generally tighter picture, absolutely.
Looking again on the supply side of the story, you mentioned Guyana and some of these others, but I wanted just to get your thoughts on the outlook. We had a story on our digest today of the Americans meeting the Venezuelans in Qatar, of all places. We've got Iran would appear in talks with the US again, and also moving as much oil as they possibly can, I think, at this stage, and the Russian oil continuing to get to market, that these very big players in the oil markets, they're not marginal characters like Guyana, obviously Russia, Iran, and the potential for Venezuela to return. Your thoughts on where they are coming into this more than expected supply piece at the moment and going forward?
Yes, Sean, you've touched on some pretty big pieces on the chessboard there, if you like. But you can always read things two ways. There was a set of statements last week about a lot of the floating inventory of Iranian oil, sanctioned everywhere bar China, right? Having been depleted, having been taken to market. So some will say, oh my goodness, that's really, really going to weigh down on the markets. That's bearish. Others will say, well, it's gone now, so therefore it's no longer there as spare supply capacity. So that's just one example of how you read things two ways. I don't know what to make of the diplomatic engagement that allegedly took place in Qatar 3 weeks ago between the Venezuelans and the Americans, but I don't think we should overestimate the capacity of Venezuela to flood the market with oil. There's been decades of lack of investment there, which is going to require some serious investment before Venezuela can return to its former glory in terms of production capacity. In other areas, we still don't have, at least unless I've missed something, we don't have restoration of flows from northern Iraq, from the Kurdish region through Turkey, despite the fact that the Turkish election has been a settled affair. I may have missed that. I've had a couple of days of leave here. You had a headline in your digest about concerns over disruption of exports to Sudan. Typically in flashpoints where there are civil war type events, oil continues to flow because whoever controls it wants the revenue. So I'm not sure we should attach too much importance to that. You probably have some sort of negative impact from the disruptions in France today. And it's that time of year where you get typhoons in Asia and you get hurricanes in the West. And for the very first time, the benchmark of the world, Brent, has a hurricane exposure because the vast majority of the barrels that can come in to set the BFOETM for Midland benchmark could be affected by delays in the US Gulf in what appears to be a season which is not just characterized by the return of El Nino, but extremely high surface temperatures, water surface temperatures, all the way across the Gulf Stream to west of the UK. And this is already generating cyclonic activity in June, which most people know is a little early for hurricane season. So one has to price in a certain amount of premium, or what I like to refer to as speculative froth, into the outlook for the size of the export programs from the US, should there be any hits on the export infrastructure in Corpus Christi and further across in Houston.
So, Mike, of course, it is July. It's typically going into the holiday season where the markets are distracted, traders go away, and volumes decline. Your thoughts on the next 2 months, the summer period, and will we come out of it with this market having a much more definitive direction? So, I welcome your sort of outlook for the summer period.
Yes, well, Christoph has, but I haven't mentioned Russia yet. So I think we
yes, if you're
keep one eye on that. But Russia has continued to come in with its exports of both refined products and crude oil at the higher end of expectations. Many people had assumed that there would be lower exports, and that continues to run at pretty big levels. So much so, of course, that people are saying, are they actually producing more than their end of the bargain under OPEC plus? But that is
essentially all going to Asia?
Well, of course, on the crude side, we have the Indian market, which is your prime baseload market, taking pretty much as they technically can. And then, of course, the Pacific flows are all ending up in the Chinese market. So that's on the crude side. On the product side, much more interestingly, yes, you have a much larger export program of products from the Baltic and from the Black Sea. And those flows are largely having to find their way through the Suez Canal, although it must be said, many countries in the global south have moderated their view towards refining, towards taking Russian refined product also. So you are seeing more material volumes staying in the Western Hemisphere, going to places that they hadn't done so before. So the amount of inquiry from new countries contemplating taking Russian oil is fine. But I must emphasize, taking Russian products at below price cap. Because of course it is still awfully complicated to find, for most of these countries, to find the banking channels, the ship insurance, and of course the shipping and the banking to take oil.
Which is why ultimately, isn't it, that $75 is a good price, because it makes that uncomplicated, doesn't it? It gets that Ural spread it's a viable thing for legal movement of Russian products and crude?
I'll answer that one diplomatically. I think,
Yeah.
I think yes, the market will always find ways of balancing, and the price will adjust to the levels it has to adjust to in order to do what the world needs, which even the G7 leadership agree to and will publicly say, which is the Russian oil is needed by the world markets, and therefore the mechanisms have to work in a way that achieves their objectives of minimizing revenues whilst at the same time serving the purpose of keeping the market adequately supplied. Yeah.
Just to finish off, Mike, on your outlook for the next 2 months, a natural period of lower volumes are traded. How could that impact the market?
Just to clarify, Sean, what did you mean by lower volumes traded? You mean,
well, the paper market tends to drop off a bit over the holiday season.
I wouldn't read too much into that. I mean, yes, we have had a much lower open interest, which I think I highlighted in one of these calls previously. So that still remains the case. There is a general lack of interest from the speculative components in the market, but also managed money in fossil fuels and oil in general. And yes, open interest is not what it once was. But by the same token, if you make the assumption that managed money and large funds wish to have a component of energy in their mix, then you can make the same argument I made before in the case of Iranian floating inventories, that at some point this interest might return. Now, many say that's not the case because oil served as an inflation hedge. If people take the view that inflation has reached a point where it's maxed out, then you don't want an inflation hedge anymore. But people don't just put petroleum, energy, gas in their portfolio as an inflation hedge. So it's going to be interesting to watch whether managed money stays on the sidelines now that we've entered the start of a new quarter.